Welcome to the Freedom Capital Management Strategies Market Review and Outlook. Hi, I'm Brian Zabora, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, could you provide us with some of the recaps of the key trends during the first quarter?
Sure, and thank you, Brian, and thank you all for joining us. The first quarter was actually another positive one for financial markets. So despite some of the troublesome headlines in the financial media, stock and bond markets rose in the first quarter after rising in the fourth quarter of last year. So we've had two consecutive quarters of gain after what was a very difficult year of 2022. And so when we look at what happened in the first quarter, first and foremost, financial markets were buoyed by a resilient economy and moderating inflation. Last year, we spoke at length about inflationary pressures driving higher interest rates and tighter financial conditions, which really pressured markets in a negative direction. Well, we experienced some real relief in the first quarter. Inflation is still high, but it's declining and decelerating from the rate that it's been. And that trend has been received positively by markets and is taking some of the pressure off of financial markets, which allowed both stock and bond prices to rise. In addition, not only has the economy been resilient, financial markets have been resilient. In the first quarter, despite the turmoil we experienced in the banking sector with the failure of Silicon Valley Bank and a few other small regional banks, we still saw the stock market grind higher through that turmoil. And by the end of the quarter, stocks as measured by the S&P 500 rose about 7.5%. That's a really strong quarter. And then bond markets as measured by the Bloomberg Aggregate Bond Index rose by about 3%, which is also a really strong quarter for bonds. So overall, we had a really strong quarter in Q1 of 2023.
Pete, thank you for those perspectives. Could you talk about some of the market dynamics and maybe what changed during the quarter?
Absolutely. And when we look under the hood of financial markets in the first quarter, there was a notable change in the underlying dynamics that drove markets in Q1 of 2023 relative to last year. First and foremost, we saw strong outperformance from growth-oriented stocks compared to value-oriented stocks. So think of growth stocks as stocks in sectors like technology, consumer discretionary, communication services. More technology-focused companies had really strong results in the first quarter. Compare that to last year, the technology and growth-oriented stocks were significant underperformers relative to the broader market last year. So that flipped on its head. Conversely, we saw pretty significant underperformance in value-oriented stocks. Think about the energy sector, the financial sector. The companies in those sectors really struggled in the first quarter of this year, whereas last year, those sectors and more value-oriented stocks were strong outperformers. So a very strong change and dramatic shift in underlying market dynamics. In addition, one of the few asset classes that struggled in the first quarter was commodities. Commodity markets at large actually saw declines in the first quarter. There were very few asset classes that saw declines in the first quarter of this year. Last year, commodities were one of the few areas that saw growth and price gains. So we saw very different dynamics in financial markets in Q1 of this year compared to 2022.
Pete, thank you for all those perspectives. Last quarter when we met, you were cautious on financial markets. Given the strong recovery that we saw, has your outlook changed?
There's no doubt we entered this year with a decidedly cautious outlook for the economy and the financial markets. And that was driven by some of the factors that really negatively impacted markets last year that we felt were still key risk factors. And when we look at the outlook through the remaining quarters of 2023, we still remain an overall cautious outlook. And the primary reason for that is we see growing signs that recession is increasingly likely in the US economy and also the global economy. And to help you understand that a bit more, there's a few signals that have notably changed in recent quarters that have been pretty reliable indicators that recession may be on the way. The first and most notable is the inverted yield curve. What I mean by that is when short-term interest rates are higher than long-term interest rates, it's a phenomenon called an inverted yield curve. This is an unusual setup for interest rates, but it does happen, and it tends to happen prior to recession. So if you go back to World War II, most recessionary environments we've entered were preceded by an inverted yield curve. And that's a strong signal that the risk of recession has risen. Second is in the first quarter of this year, I mentioned this earlier, but the banking sector experienced a significant degree of turmoil. Silicon Valley Bank failed, Signature Bank failed, and we had a lot of pressure across regional banks as depositors were pulling cash out of banks, which caused challenges for their operating environment, and it caused a significant degree of regulatory oversight and action in the banking sector. That also is a sign that not all is well in the plumbing of the financial system. And when the Federal Reserve raises interest rates rapidly, like it has been doing over the last year and a half, that tends to eventually cause something to break. And we believe some of the banking sector turmoil was the first signs that some things may be breaking in the plumbing of the financial system. The third factor that we're watching that gives us some cautious pause is corporate earnings and margins have been declining. And while much of this has been expected, we continue to see earnings expectations grind lower amid higher interest rates and some challenging environments for corporations. So that also is a sign that there may be some trouble lying ahead. And then finally, the story of last year was around inflation. And while I mentioned earlier that the trend in inflation is improving, inflation levels are still very elevated relative to history and relative to central bank targets. And because of that, when we look at inflation, central banks are likely going to continue to be pretty restrictive with their monetary policy and keep interest rates elevated, which is another source of potential pressure on the economy and markets.
Yeah, I understand the reasons for caution. However, are there reasons for optimism for investors?
There are, and as usual, the future is very difficult to predict. So while we believe that the balance of factors points to more risk on the horizon, there are some pretty compelling and optimistic narratives at play in markets and the economy right now. First and foremost, the job market remains resilient. We continue to see job growth steadily month after month. The unemployment rate is historically low, and jobs are available for those who are looking for them. So that tends to be a sign of resilience in the economy. Second, the U.S. consumer remains healthy. There's still a significant degree of pent-up savings that consumers have at their disposal, and they're beginning to spend, and they have not spent down all of those excess savings to date. So that should continue to cushion economic growth ahead despite some of the challenging factors we spoke about. And then the third point is the housing market. Many predicted that the housing market was going to really struggle amid mortgage rates that rose dramatically from 2 to 3% to 6 to 7% in the course of a year. But the housing market has remained surprisingly strong. We've seen some pressure on housing prices, but not material pressure. We've also seen, while sales activity has slowed down, we haven't seen a lot of fire sales of homes, and there's inventory levels that are very low. So the fundamentals of the housing market, which is a big driver of consumer spending, also remain pretty resilient. So when we put that picture together, we still have a resilient economy. And while we're looking forward and asking questions about the risks on the horizon, the reality today is that the economy remains pretty strong.
Pete, in light of the mixed signals of both positives and negatives, how should investors navigate this challenging environment?
As always, it's difficult to navigate markets, and volatility remains ever present. No different than it was last year, it remains today. And there's some timeless principles that we believe are critically important for investors to keep in mind in the context of their long-term financial plans. First and foremost, don't try to time markets. It is a strategy that has proven very difficult for investors for generations on end, and we continue to remain so today. And it's fundamentally because the future is unknowable. So stay disciplined and don't seek to time markets. Second point, stay diversified. It's important to manage risk, especially in an uncertain environment, given some of the risk factors I spoke about earlier. And diversification has actually increased in appeal over the past year. One of the challenges for investors in recent years, and really over the past decade, was that with interest rates so low, bonds and cash were not offering compelling long-term return potential. That changed remarkably over the course of the past year, and now bonds and cash offer relatively attractive yields and are a good source of diversification for equities, which was not the case for much of the past decade. So stay diversified. Third point is focus on resilience in your portfolios. When the economic environment is uncertain and there's recession risk rising like there is today, resilience is important. And when I say resilience, I'm speaking of quality companies with strong balance sheets that are generating positive cash flow and that can weather a slowdown in an economic environment. And then lastly, and most importantly, stay engaged with your financial advisor. Make sure your financial plan is a living plan as you navigate volatile and dynamic financial markets.
Pete, thank you for those insights, and thank you for joining us today. We look forward to coming back to you in the next 3 months to provide you another market update and review.
Thank you.